There is one chart that has successfully predicted every recession going back 50 years. And it has just predicted a new recession that could happen at any time. But this recession's running late. Is this time different? Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. And I didn't stop at just one indicator. I compiled the top 5 indicators going back 50 years of an upcoming recession. And I also switched it from recession to bear market, because as an investor, if we're looking through the lens of investing, we care more about bear markets. Is the stock market actually going to drop? Because recessions are bad, but they don't always mean a bear market is coming. So what is a bear market? A bear market is when the stock high drops by 20%. That's how you know you're in a bear market. And a recession is defined as a period where the gross domestic product, the GDP of the US, drops for 2 consecutive quarters. The GDP is just how much is everybody spending. So if people are spending less for 2 consecutive quarters, then there has been a recession. And recessions are correlated with bear markets. There are generally 4 things that happen during a recession. Employment rates drop, businesses invest less, consumer spending drops, and industrial production drops. Now, when these 4 things happen, generally the stock market does go down too, but not always. Typically, there needs to be at least 2 other indicators alongside a recession to be confident that a bear market is coming. So what are these 5 most common indicators? The first one that never fails to predict a recession, or at least it hasn't, is the 10-2 inversion. The 10-2 inversion refers to the 10-year Treasury bond yield and the 2-year Treasury bond yield. Normally, you would expect a higher interest rate to invest in a 10-year bond because your money is going to be locked up for 10 years. So that's like higher risk. Whereas if you lock your money up for 2 years in the 2-year bond, you would expect to receive a lower rate. Now, when those two invert, meaning the 2-year bond is giving you a higher rate than the 10-year, that is a major red flag. So why does that happen? The interest rates are reacting to market demand. So if a bunch of people are wanting to buy 10-year bonds, then the rate will go down because people are willing to gain a lower rate in order to get the 10-year bond. Now, if people are really scared about the future of the economy, then people are really going to want that 10-year bond, and they're not going to want the 2-year as much. They want to save their money for longer. So the demand for the 10-year bond goes way up, meaning the interest rate goes down for it. And the demand for the 2-year goes down, meaning the rate that you get for the 2-year goes up. So this chart here shows every time that the 10-year and the 2-year yields invert. And that is shown whenever the blue line drops below the 0-point axis. At that moment, the yield inverts. And all of these gray sections here show recessions. So every single time that the yield drops below 0 there is a recession within 2 years. So we see it here in 1978, the yield inverts, and then we have a recession in 1980. The yield inverts again, and we have another recession here. The same thing happens in 88. The same thing happens in 2000, 2008, and then here's the little COVID crash in 2020. It happens here as well. So this indicator has been very successful at picking recessions, but again, we're looking for a bear market. So I'm going to couple this indicator with 4 others. The next major indicator is the federal funds rate. Generally, the Fed will use the federal funds rate. This is the rate at which banks can borrow money from the government. They will use this rate to control inflation. If inflation is incredibly low, then the federal funds will reduce their interest rate, meaning it'll be much cheaper to borrow money, which will stimulate the economy. If inflation gets too high and there's too much money in circulation, then the Fed will raise its rate, meaning it's more expensive now to get a loan, which will dampen the economy. So generally speaking, the federal funds rate being raised means inflation is coming. And then whenever they drop the federal funds rate, they're trying to get inflation back under control. This chart shows the federal funds rate, and in the blue line and the gray sections are when we see recessions. So we see a pattern emerging. The Fed raises interest rates to get control of inflation. And then whenever they have control of inflation and they've managed to push inflation back down by raising interest rates. That's whenever the economy is at its worst, is when they realize that, oh my God, we need to lower rates again, because with these high rates, we've crushed the economy. And so whenever you see the dropping of the interest rates, that is where we see the recession. So we see a rise in interest rates and then a sharp drop associated with recession. A rise in rates and then the drop. And this pattern repeats again and again and again. Now, sometimes we will see a rise in interest rates and then a drop without a recession. So it's not a perfect indicator, but there is a really high correlation. So the federal funds rate, really good indicator to add to our toolbox. The third indicator is margin usage. Margin is basically getting a loan so that you can invest that money in a security. Whenever people are using lots of margin, it means the stock market is probably on all-time highs. People are very confident in the stock market. There's a lot of overinvestment. Valuations are probably up higher. And if the stock market starts to go down at all, then people have to sell their securities so they don't lose a bunch of money on margin. If I borrow money to invest, then my losses are magnified if the stock market goes down. So when you see a lot of people with a lot of margin, if the stock market drops a little bit, it can start a chain reaction where you have a bunch of people that suddenly all need to sell because there's so much margin usage. And then that increased selling, that rapid selling of stocks, can cause the stock market to drop. So this chart right here shows in red the margin usage as a percentage of the money in circulation. The axis on the right shows the margin ratio to money in circulation. If that red line ever exceeds 0.4, then there is a recession soon to follow. We see that again and again. The fourth indicator is consumer confidence. When we see a massive drop-off in consumer confidence, then that is typically coupled with a recession. This chart shows the long-term adjusted consumer confidence, 100 being average. So when we see consumer confidence rise above the average and then have a stark drop-off, there is a strong correlation with a recession. And when there's a recession, there's a strong correlation with a bear market. The fifth and final indicator is known as the Buffett indicator. This looks at the valuation of the stock market and compares it to the gross domestic product. When the value of the stock market exceeds the gross domestic product by too much, then Warren Buffett says that the stock market is overvalued. This chart right here shows the Buffett indicator, and it uses standard deviations. Whenever the stock market is more than one standard deviation away from the average, Warren Buffett declares the stock market is overvalued. And this is highly correlated with recessions and with bear markets. In the last 50 years, it has happened at the end of 1970, and it happened again in 2000. It did not happen in 2008 because the stock market had just dropped from the year 2000. And then just before COVID, it happened again. And currently, the stock market is 2 standard deviations over the average, so it is strongly overvalued. This indicator does pair nicely with the margin usage. However, they are still 2 separate indicators, because if there is high margin usage, then it can really amplify a crash, whereas the stock market can be overvalued, but there might not necessarily be margin usage at that time. I have compiled all of these indicators into this Excel spreadsheet, and I've got the dates on the left going back 50 years. We've got bear market, which is what I'm trying to predict, the 10-2 inversion, current recession, margin usage, rate drop, that's the federal funds, consumer confidence, and stock valuations. That's a total of 6 indicators. I tend to not see a bear market unless a recession is combined with at least a couple other indicators. And then on the right, I have that totaled up. So we can scroll down through all this data and come to my graph at the bottom. So the way this graph works is the gray sections are bear markets. They're not recessions. In this case, I get 1 point for a recession and 1 point for all other indicators. So if we go back to 1980, we can see that there are 3 indicators, including the orange recession, that leads to a bear market in less than 1 year. Now, there's one outlier, or I guess there's 2 outliers in this string of data. First, there is a bear market that happens in 1987 that did not have the proper indicators. We did see a recession, but we did not see additional indicators stacked on top of that. And this was a black swan event known as Black Monday, a crazy event where the stock market got really unexpectedly crashed. So there was no indicator for that bear market. But let's move on. Next, we see 3 indicators lining up in 1990. However, there is not a bear market associated with that. If we go look at the stock market at that time, we did see a major drop in the stock market. It just didn't quite reach the 20% threshold. So there was still a predicted stock market drop at this time, just not quite a bear market. And then rolling forward into the year 2000, this is associated with the dot-com bubble. We saw 3 indicators leading into a bear market. This time, there was not a recession leading indicator, but there was 3 other indicators. The recession did not hit until we were already into the bear market. That's why it's so important to look at the smoke. There might be smoke before the fire. And yes, there's smoke during the fire, but it's not that easy. It's hard to tell if you're on fire because you could be in the middle of the bear market, but you won't actually know that it's a bear market until after the stock market has dropped by 20%. Sometimes it takes a little bit of time for the market to actually drop by 20%. So it's good to keep track of the indicators while you're in the middle of it. So in this case, there was 4 indicators at the beginning of the bear market, and then there was 3 indicators before the bear market. Moving forward to 2008, the financial crisis, there was 3 indicators, this time including a recession, peaking at 4 indicators. Moving forward to the COVID crash, there was 3 indicators with just a couple months of warning on this one. Everything happened really fast, but there was 3 indicators. And then again, we had a short bear market in 2022, and there was 4 indicators warning us before that crashed. And now here we are today. It has been 3 quarters. It's been 9 months where we have had 3 indicators, but we have still not had a crash yet. I don't think this time's different. I think we are in a position where there will likely be a bear market. So the question is, what am I doing about that? Does that mean I'm going to go and sell all of my stock? No way. I'm not going to sell out of anything. The way I like to handle a bear market is I like to change the way I invest new money. I put a greater emphasis on value stocks, and I put a greater emphasis on companies that are in sectors that are resistant to recession and resistant to bear market. If you're curious to see a breakdown of how I make that happen, check out this video right here, and I'll catch you on the flip side. Cheers. Oh, if there is a bear market, I'm going to need a lot more of this.